The greatest financial threat during a severe economic contraction actually isn't a stock market crash. A 35% drop in a retirement account is, well, at the end of the day, it's just a paper loss. The true danger, the actual mechanism that permanently destroys generational wealth, is experiencing localized income disruption at the exact moment your debt obligations structurally spike.
Right, yeah. That simultaneous squeeze is what basically forces liquidations. Your cash inflow from your salary halts while the cost of carrying your liabilities suddenly accelerates, mostly because the broader credit markets are seizing up.
Welcome to a special daily fiscal audio edition of our deep dive. We are keeping things incredibly grounded, authoritative, and strictly data-driven today. There will be absolutely no panic here and zero doomsday forecasting.
Just the numbers.
Exactly, just the numbers. We are looking at the blueprint for structural financial resilience, pulling from our source text today, which is the 2027 Defensive Playbook. The mission is to methodically break down a three-step macroeconomic recession protocol so you can build an impenetrable financial fortress.
And it's a really timely protocol to dig into.
Okay, let's unpack this because, honestly, I'll be the first to admit that talking about playing defense right now feels entirely counterintuitive. Speculative assets and markets have been on an uninterrupted historical tear. When capital is cheap and everything is just surging, capital preservation protocols feel like, a relic of the past.
Yeah, it's a super common psychological trap, honestly, to just extrapolate current market conditions into infinity. But the cycle reality we have to understand is that economic expansions do not simply die of old age.
Right.
A bull market doesn't just check a calendar, realize it's been running for 10 years, and decide to quietly retire.
Like it's moving to Florida or something.
Exactly. They die for specific, measurable reasons. They die of structural imbalances, restrictive monetary policy, or unpredictable black swan shocks. So preparing for a potential 2027 contraction isn't about fear or pessimism. It is mathematically critical. Volatility is simply the toll we pay for historical market returns.
But building a financial fortress doesn't start with the outer walls. You can't survive a siege if the courtyard inside your castle is already on fire.
That's a great way to put it.
Which brings us to the first mandate in the playbook: eliminating variable lethality. The source targets the hidden rot in consumer balance sheets, specifically highlighting the normalization of buy now, pay later cycles. Consumers are essentially masking their actual cash constraints by spreading payments out, which creates this illusion of liquidity.
And it's so easy to look wealthy when credit is flowing freely to bridge those gaps.
Right. But what happens when the macroeconomic tide goes out?
Well, the credit dries up instantly, and that exposes the mechanics of what the playbook calls variable lethality. Let's look at the specific example provided in the text. You have an individual carrying a $14,231 balance on a variable rate credit card.
Just floating that balance month to month.
Exactly. During an expansionary period, that individual might just be managing the minimum payments, kind of ignoring the underlying principle because their job feels totally secure. But when macroeconomic conditions tighten, that specific debt vehicle weaponizes against them. The card is suddenly charging a 24.9% penalty APR.
24.9% isn't just a penalty. Mathematically, it's a wealth extraction engine. No retail investor can reliably out-earn a 25% headwind in the public markets.
It's mathematically impossible over the long term.
Yeah, if you hold that debt, your balance sheet is basically bleeding out.
And we have to look at why that rate spikes at the worst possible time. It's not a coincidence. When the broader economy contracts, banks move defensively to protect their own balance sheets.
Right, they're looking out for themselves.
Exactly. They proactively lower consumer credit limits and hike rates on variable debt to price in the new default risk. So at the exact moment you might face a corporate restructuring, reduced hours, or just outright job loss, the baseline cost simply to maintain that $14,000 debt skyrockets.
It acts like a parasite that just consumes whatever small amount of liquid cash you've managed to save.
Perfectly said.
So the frontline defense is incredibly aggressive. You don't prepare for a recession by shifting your portfolio into gold or hoarding conservative bonds. The immediate priority is nuking that consumer debt.
Totally.
The text dictates consolidating it into a fixed-rate personal loan or aggressively rolling it onto a 0% balance transfer card. And the mechanism there is what really matters.
Because by moving to a fixed-rate loan, you are legally severing the bank's ability to dictate your cash flow?
Right. If the Federal Reserve changes its policy, or if the credit markets panic, your obligation remains static. You are locking the door against variable lethality.
And by utilizing a 0% balance transfer, you're effectively hitting the pause button on compounding interest. You're granting yourself a defined window to just attack the principal before the broader economic storm hits. You're taking back control of your monthly outflow.
But, putting out the fire of variable debt doesn't save your house if your primary income stream completely dries up. You can't pay even a fixed-rate loan with $0.
Which is the harsh reality.
Yeah, and that exposes a massive structural flaw in the old personal finance golden rule, the whole 3 to 6 month emergency fund idea. The playbook argues that this specific time frame is now dangerously outdated.
What's fascinating here is how fundamentally the modern white-collar labor market has evolved, and really why the old math no longer applies.
Tell me about it. It's a different world.
It really is. The current corporate landscape is hyper-fragmented and incredibly specialized. 10 or 15 years ago, if a mid-level manager lost their position, the generalized nature of their skills meant they could relatively easily slide into a parallel role at a competitor within a couple of months.
The hiring friction was significantly lower back then.
Much lower.
Right.
Today, roles are intensely specific, and corporate HR departments have become incredibly risk-averse, especially during a contraction.
So the process is exhausting now.
It's wild. The hiring processes now routinely require 4, 5, sometimes 6 rounds of interviews, take-home case studies, and extensive panel reviews.
Just to get a maybe.
Right. If a white-collar contraction occurs in late 2026 or 2027, the duration required simply to navigate an interview pipeline and secure an offer will expand drastically. Companies will freeze hiring to assess their own balance sheets, and when they do open a headcount, they will take their sweet time to ensure a perfect fit.
So a 3-month emergency fund will evaporate before you even make it to a third-round panel interview.
Exactly. The mandate is clear. You need 9 fully funded months of liquid cash.
Here's where it gets really interesting.
Mm-hmm.
And by interesting, I mean structurally devastating if you aren't prepared.
Oh.
The text outlines the exact disaster scenario of an underfunded liquidity wall. Imagine that 3-month fund runs dry. You still have a mortgage or rent due. You have completely neutralized your variable debt, sure, but you simply need operational cash.
The groceries still cost money.
Right. So the immediate temptation is to breach the retirement accounts. People start pulling cash from a 401k. The author calls this the triple tax of poor planning, and the compounding math behind it is just brutal.
It is the ultimate trapdoor for long-term wealth. I've seen it destroy so many financial plans.
Let's walk through the mechanics of that triple tax. First, if you pull money out of a traditional 401k, you are triggering immediate income taxes on that withdrawal. You're turning tax-deferred growth into a sudden tax liability.
Which hurts right off the bat.
Right. Second, assuming you are under retirement age, the IRS levies a 10% early withdrawal penalty directly off the top. You are losing a massive percentage of your capital before it even hits your checking account.
It's just vanishing into thin air.
And the third tax is the one that permanently alters your financial trajectory. You are locking in the losses.
This is the critical one. Because you're executing this withdrawal during a macroeconomic recession, the broader equity market is likely severely depressed. You are being forced to sell your shares at the absolute bottom of the market just to generate operational cash.
You take a temporary paper loss, convert it into a permanent realized loss, and then hand a significant chunk of the remainder to the government.
Which perfectly illustrates why this 9-month liquidity wall must be fully capitalized before the crisis begins.
Right.
If you're forced to sell assets during a panic, you are effectively subsidizing the wealth of the investors who are prepared. You are handing them your fundamentally sound but currently discounted shares.
Which brings up the critical question of where this 9-month capital reserve should physically reside. Because, a very common retail investor concern is that holding 9 months of living expenses in a zero-yield checking account means losing purchasing power to inflation.
Sure, it creates this psychological itch.
People feel like their cash is being lazy, so they try to optimize it. They look at a junk bond ETF or a high-yield corporate debt fund, thinking they can squeeze out an extra 6 or 7% return while still calling it an emergency fund.
And the playbook is incredibly authoritative on this point. This 9-month liquid cash wall should absolutely not be chasing yield in risky corporate credit vehicles.
Not the time to get cute with your money.
Exactly. The singular purpose of this capital is preservation. You do not build a fortress wall out of speculative materials. During a liquidity crunch, the underlying companies in those high-yield corporate debt funds struggle to refinance their own obligations.
Defaults rise.
Defaults rise, and those funds can enact redemption gates, freezing your ability to withdraw your money when you need it most.
So the capital belongs strictly in FDIC-insured high-yield savings accounts or direct short-term treasury bills.
Absolutely.
And the underlying logic there relies on the guaranteed nature of the risk-free rate. FDIC insurance means the federal government explicitly backstops your deposit against institutional bank failure. And short-term treasury bills are backed by the full faith and credit of the U.S. government.
When corporate bonds are defaulting and the broader markets are panicking, a 9-month wall held in those specific instruments remains entirely intact, instantly liquid, and mathematically insulated from market volatility.
It's boring, but it works.
Boring is beautiful in a recession. The true return on your emergency fund isn't the nominal interest rate it yields. The return is that prevents you from ever experiencing that devastating triple tax on your long-term investments. It is literally an insurance policy that you fund yourself.
Okay, so with the day-to-day survival fully secured by that cash wall, we can safely zoom out to part 3 of the playbook, auditing equity portfolios for risk drift. This is where we examine the long-term wealth vehicles.
The fun stuff.
Yeah. Now, over the last few years, aggressive growth sectors, specifically mega-cap tech, have driven massive portfolio gains. I mean, everyone looks like a genius. But the playbook asks a sobering mechanical question. What actually happens to those valuations when the Federal Reserve holds interest rates higher for longer and corporate earnings face genuine downward compression?
We have to look at how high multiple growth stocks are fundamentally valued. I mean, their current stock price isn't primarily based on the cash they generate today. It's based on the massive theoretical cash flows they're expected to generate 10 or 20 years in the future.
Right.
To determine what those future profits are worth today, analysts apply a mathematical discount rate, which is heavily influenced by the baseline interest rates set by the Federal Reserve.
Meaning if the Fed raises the risk-free rate to 5%, an investor no longer needs to take on massive equity risk and wait 10 years for a tech company's theoretical profits because they can just get 5% guaranteed today.
Exactly. And that mathematical shift in the discount rate instantly crushes the present-day valuation of those future earnings.
It just pulls the rug out.
It does. And when a macroeconomic contraction actually hits and those companies face downward earnings compression, well, those high multiple growth stocks take a brutal beating. Their previous valuations were constructed in an environment of cheap, easy capital that simply no longer exists.
This exposes a hidden danger the source identifies as accidental risk drift. I want to look at the mechanics of how this sneaks up on an investor.
It's so insidious because you don't even have to do anything wrong for it to happen.
Right. Let's say 5 years ago, you mapped out a prudent, age-appropriate asset allocation. You decided on 70% equities and 30% fixed income. You built a nice, balanced portfolio. But then we experienced this historical, sustained rally in mega-cap tech.
Unprecedented growth.
Yeah. So the tech portion of your equity bucket grew so fast that it completely consumed the portfolio's balance. Without you ever actively executing a trade, that 70-30 split has accidentally skewed to 88% equities, heavily concentrated in highly leveraged tech sectors.
Accidental risk drift is like loading all the heavy cargo onto one side of a ship over 5 years simply because the weather happens to be nice.
I love that analogy.
The ship continues to sail fast in calm waters, but your center of gravity is now severely compromised. The moment a macroeconomic storm hits, you are structurally positioned to capsize.
Yeah.
If your portfolio has drifted to 88% equities, you are bearing a level of risk that you never logically authorized in the first place.
But let's be realistic about the psychology of fixing this. The playbook dictates that we need to rebalance, right? To sell some of those massive tech winners and reallocate the capital back to our original 70-30 baseline, often buying slower-growing assets.
Which hurts to do.
Yeah. You're telling someone who just watched their tech portfolio grow by 150% to sell a portion of it and buy a consumer staple company that makes toothpaste. Psychologically, that feels like giving up. It feels like you are trying to time the top of the market and guessing that tech is about to fall.
Yeah.
How do you override that human urge to just hold on to runaway winners?
Well, this requires a very strict differentiation, and I must be incredibly clear on this point, as the playbook is equally forceful here. Attempting to time the market structurally destroys wealth. Let me repeat that because it is the most vital disclaimer in this entire analysis.
It's huge.
Attempting to predict the exact peak of an expansion, liquidating your portfolio to go to cash, and hoping to precisely buy back in at the absolute bottom, that is market timing. And historical data proves across decades that market timing structurally destroys long-term wealth.
Because investors inevitably miss the sudden massive rebound days that generate the bulk of historical market returns.
Exactly. You simply cannot predict the timing of black swan events, whether they are negative shocks or positive recoveries.
You just can't.
You cannot. But rebalancing is fundamentally different from market timing.
Okay, unpack that difference for us.
Rebalancing is a mechanical, unemotional, and mathematical process. It is systematically locking in gains from your runaway assets and deploying that capital back to your established risk-adjusted baselines. You are not making a speculative bet on what the tech sector will do tomorrow. You are simply enforcing the risk parameters you logically decided upon when you constructed the portfolio with a clear head.
You are systematically forcing yourself to sell high and buy low, stripping the emotion entirely out of the trade.
Precisely.
And in the context of the 2027 defensive playbook, this means rotating those inflated portions of the portfolio back toward historically defensive bulwarks. The source specifically points to dividend aristocrats, healthcare, and consumer staples. Let's look at the underlying mechanics there. A dividend aristocrat is a company that has not only paid but consistently increased its dividend payout for at least 25 consecutive years.
Which is incredible consistency.
Yeah, how do they manage that through multiple past recessions?
They manage it because of the inelastic demand for their underlying products. Look, no matter how severe a recession gets or how restrictive monetary policy becomes, consumers are still going to purchase basic hygiene products. They are still going to fill their prescription medications. They are still going to buy basic groceries.
The essentials don't go out of style.
Right. These sectors possess deeply entrenched, reliable cash flows. They aren't going to give you the 40% annual pop of a speculative artificial intelligence startup, obviously. But during a genuine downward compression of corporate earnings, those reliable cash flows act as a structural shock absorber for your wealth.
It cushions the blow.
Absolutely.
So what does this all mean? We've covered a lot of technical ground today on the Daily Fiscal Audio. We've examined the wealth-extracting mechanics of variable APR debt. We've established the absolute necessity of a 9-month liquid cash wall housed strictly in FDIC accounts, or T-bills, to survive the modern white-collar hiring cycle.
Which is a beast.
It really is. And we've audited the hidden structural dangers of accidental risk drift in your equity portfolios. To bring this all home for you listening, the text outlines a concrete 3-step action plan to start executing today.
Right now.
Step 1. Execute the stress test. Sit down and mathematically calculate exactly how many months of absolute bare-bones living expenses your current liquid cash could cover tomorrow. Target greater than 6 months, pushing strictly toward that 9-month ideal.
Just get the raw number on paper.
Yeah. Step 2. Halt lifestyle creep. If you receive a bonus or a salary increase during this current expansionary cycle, do not inflate your household burn rate. Allocate 100% of that new capital directly to fortifying your balance sheet and funding that liquidity wall.
Don't buy the new car, fund the wall.
Exactly.
Yeah.
And step 3, rebalance to your target. Log into your brokerage accounts, assess your current allocations, sell the high-performing fractional overweights, and purchase underperforming defensive assets, strictly realigning with your original age-appropriate risk tolerance.
If we connect this to the bigger picture, the final verdict of the playbook is profound, I think. Macroeconomic recessions represent one of two things for an individual. They are either a generational catastrophe or a generational buying opportunity.
There's really no middle ground.
Not really. And the deciding factor between those two outcomes is entirely dictated by the structural health of your balance sheet before the National Bureau of Economic Research officially declares a recession. The NBER is historically a lagging indicator. By the time they announce a contraction, the damage is already priced into the market.
Too late.
Way too late. If you possess zero high-interest debt, heavily insulated cash reserves, and a disciplined portfolio well, a 2027 recession simply becomes a flash sale on global equities.
You have the liquidity to survive the storm, so you aren't forced to liquidate your assets at a loss. Instead, you get to purchase high-quality assets while institutional panic drives the prices down. You basically become the beneficiary of the volatility rather than the victim of it.
That's the whole point of the playbook.
That wraps up this Daily Fiscal Audio edition of The Deep Dive. Thank you for joining us as we mapped out the blueprint for your financial fortress. We'll catch you next time, but before we go, I want to hand it over for one final thought regarding capital preservation.
Yeah, so the philosophy of preparation extends far beyond just stocks and bonds. This raises an important question to leave you with. If a recession truly is just a flash sale for the well-prepared, look at your own life and career right now. Beyond your financial portfolio, what specific skills, credentials, or professional opportunities are currently too expensive in terms of time or capital for you to invest in today, but that you would immediately want to acquire if the economy deeply discounted them tomorrow?